In New York City, I'm Julie Hyman, that's Josh Lipton. This is Yahoo Finance Live, and here's what we're watching this afternoon. We're an hour away from the closing bell on Wall Street, but it's not stocks making the biggest moves. Today's action, all about crypto. Bitcoin soaring above 64,000 at one point, coming back though, hitting its highest level for a moment since 2021. It's well off the highs after a Coinbase outage rippled through the market.
And the broader market's red across the screen right now. The Dow Industrial is on track for its third straight decline as investors wait on the Fed's favorite inflation gauge. That, of course, the PCE index. Ahead of the data, one Fed official saying there is more work to be done to get inflation down to the central bank's 2% goal. We've got to look at what all of this means for your portfolio straight ahead.
And a batch of earnings due after the close. Salesforce, HP Inc., Paramount among the names to watch. We'll have the breaking news and analysis as soon as the numbers hit the tape. Let's get you up to speed on the market action. Take a look at what stocks are doing. We've got Bitcoin as well, but before we get to that, I want to talk just briefly about what we're seeing in the major averages here. We've got the S&P down about 1/5%, the Nasdaq down 0.5% today. It's leading the declines, and the Dow down 0.5% as well. But indeed, a lot of the action today has to do with what we are watching in Bitcoin, the crypto asset jumping past 60,000. Getting up, it depends on where you're looking on the different exchanges. Different exchanges have different levels here, but definitely seeing the highest that we've seen in quite some time, Josh. And the action that we've been watching that is so interesting here has to do with this drop, little drop that we saw happen. And that was after Coinbase said some of its users were reporting that they were seeing zero for some of their accounts. So they tweeted about it earlier today. That then got a lot of attention. Basically, they're saying some users might see a zero balance. They said your assets are safe, but you might see a zero balance. And then Brian Armstrong, the CEO, saying they had seen a large surge of traffic that caused that. And then finally, Coinbase is saying some of those accounts are back up and running. Anecdotally, we've talked to some folks whose accounts are back up and running now. But let's talk a little bit more again about the price action. I know you've been watching all the big numbers.
Yeah, just to put some numbers on this, Julie, because it is just a kind of remarkable comeback you have seen for Bitcoin. So you jump past 60,000, which, by the way, is the first time we've been at these levels in more than 2 years. That means you're actually getting closer now to that record, that all-time high, which was 69,000, and that was back in November 2021. So the price action is pretty incredible here. And really, let me just do year to date too. We could see that, because that alone, if you just look at that, so you're up about 40% already this year. You've actually tripled from the start of the beginning of last year. And kind of in context there, you bring it back to 2022, right? You saw this plunge. I mean, you saw Bitcoin nosedive about 60%. And, you know, we've talked about this. It wasn't just that price action. It was all that kind of came with it during that period. All the drama, the trials, the scandals. I mean, there were really people, Julie, remember this, who were really questioning just the future and the viability of these digital assets. And so you have seen now just this comeback, just a remarkable, fierce rally here.
Yeah, I mean, and here's the 3-year chart here, including that high that you mentioned. That was a couple of years ago. What's interesting is, even as you say that, you know, you had that period of scandals that coincided with the so-called crypto winter, you still have the criminal situation with Binance sort of resolving itself, getting to the end of that. There has been an uptick in investigations related to alleged social media related fraud connected to crypto. So that stuff hasn't necessarily gone away. That's what's kind of fascinating here, even as we see it come back up, helped in part by the spot Bitcoin ETFs introductions. But it's been an interesting and sudden move upward.
And you pointed this out as well. It's all, you do have that drama and some of it's still playing out. But then, of course, as you know, as you've mentioned, you have the Bitcoin bulls would point to some of these other drivers. Spot Bitcoin ETFs, one of them kind of limiting supply. If demand holds steady, you wonder what it could mean for the price action in the near term. And also, of course, some speculation about spot Ethereum ETFs. Maybe that's playing too. And also that market dynamic we talk about, the Bitcoin halving, that's coming up as well in April.
All of that may be true. Yeah. But as we talked about a little bit yesterday, and as I wrote about in today's takeaway in the morning brief, there's also this sort of a number go up philosophy. In other words, you buy because the price is going up and you want to participate. and you think the number's going to continue to go up. And so far this year, it has.
It has worked.
Yeah.
Yep.
So let's talk to somebody else who thinks number go up, I think. We'll talk to him about it. Sean Farrell, Fundstrat Global Advisors, Head of Digital Asset Strategy. Sean, what do you think is behind this latest surge, or is this just sort of what Bitcoin and specifically and crypto more broadly does here with the cycles it goes through?
Yeah, thanks for having me on. I think the official terminology for the number go up feature that you mentioned is FOMO.
Right.
Yeah, I think last time I was on here, we were kind of talking about kind of some macro headwinds that occurred. In the beginning of Q1, we had a repricing of rates, right? We had a rethinking of the frequency and timing of Fed cuts, and we had a large Treasury issuance, and this was putting a lot of upward pressure on rates, a lot of downward pressure on liquidity conditions, and Bitcoin being this hedge against monetary debasement naturally does well in looser monetary conditions, better liquidity conditions, well, we're kind of past that. But frankly, seeing how equities are performing, seeing how their assets are performing, and pairing that with the incredible inflows that we've seen in these ETFs, it's hard for me to not say we've kind of detached from, at least in the immediate term, macro, and we are as you alluded to, we're kind of seeing this number grow up technology work in real time as these, salespeople at BlackRock and other large asset managers start to bring this new cohort of people into Bitcoin and see Bitcoin as a mainstay in their portfolio.
I'm interested, Sean, when you talk to maybe your friends and family, and they ask why should I move into Bitcoin? I'm interested, Sean, some of the reasons you tell them. Do you tell them store of value, digital gold, simply it's an exciting technology, maybe all three? What are the reasons, Sean, you would explain to them?
Yeah, so the reason to own Bitcoin varies depending on who you're talking to. I think if you're talking to somebody in the West, you could say that you are investing in a global network that is, already powering a better currency for people in the global South. We made all-time highs in Nigeria and Argentina and whatnot a very long time ago. So there's that element, right? The fundamental element. But then if you also look at it just from an investment, if you look at it from like a portfolio perspective and what it actually serves, it's as I mentioned earlier, it's a hedge against monetary debasement. And so if you can see a world in which over the long term fiscal deficits start to compress, we start seeing a more austere government, monetary conditions tighten for some prolonged period of time. In other words, the dollar somehow starts to retain its value, then in that case, you'd probably want to be bearish Bitcoin. But to me and to most logically thinking people, that's not a very high probability scenario.
Sean, what is the best way to invest in it? Now, especially that you have some new products on the market. And I would ask this also in light of the fact that we're talking on a day where Coinbase had an interruption, right? So with the view that they're, even at this level of maturity, that still, it seems the system can get overwhelmed sometimes.
Yeah, absolutely. Look, I think my cop-out answer is it depends on your risk tolerance, level of, whether you want to be very high touch, if you're, trading in and out of positions. So it depends on really what your personal risk tolerance is. But, I kind of preach a diversity of custody solutions, right? And so I do have some Bitcoin on Coinbase. I do have some in my brokerage account now in the form of ETFs. I do have some self-custody such that I can use it in DeFi, and I'm not, I don't have to, I'm not operating at the whim of a centralized service. So that's kind of what I would, preach in general. But I think I wouldn't let a single Coinbase outage kind of deter you from using their service. We saw, outages across a bunch of exchanges, and this actually happens during every buying or selling frenzy. They kind of just get DDoSed, but it's a good sign. It's very bullish because it means that people are coming back into the market for the first time in a long time.
Sean, I want to get you out of here on this. There's another event coming up here. The so-called Bitcoin halving happens in April. This kind of market dynamic happens every 4 years. Historically speaking, Sean, what has that event, the Bitcoin halving, actually meant for Bitcoin? What's been the impact?
Yeah. So for the uninitiated, the Bitcoin halving is a programmatic decrease in the number of Bitcoin produced per block, new Bitcoin produced. So essentially the inflation rate gets cut in half, and the new Bitcoin coming to market is a lot less. It's 50% of what it was prior to the halving. And so obviously that is positive, a positive supply dynamic. It's positive for flows. You have half of the Bitcoin that was available for sale on a daily basis now for sale, right? And so it's very constructive from a denominator perspective. But I think more importantly, it just kind of it also creates a narrative, and it stimulates inflows, and so you actually have this bidirectional catalyst where you have both the narrative forming along with these constructive supply side effects. And so far there have only been a few halvings, but so far we have 100% hit rate on incredible returns post halving. So it's certainly something that we are excited about.
Sean, finally, while I have you here, got to get a target from you. Always love the big numbers, and you guys at Fundstrat do a lot of good work on sort of gaming out what the rest of the year is going to look like. Do you have an end of year target, and sort of how close are we getting to it?
Yeah. So we issued a target of 126,000 back in early January. Everyone can feel free to visit, our research services to review our rationale and kind of how we're thinking about things. But high level, we have the optimal conditions from a Bitcoin specific perspective. We just discussed ETFs, we discussed the halving, and then we also have the high likelihood of easing monetary conditions. We have rate cuts coming, possibly tapering or cessation of QT, and obviously Bitcoin likes easier financial conditions. So you kind of have this perfect storm of very suitable conditions for Bitcoin and other liquidity sensitive assets to thrive.
Sean, thank you so much for helping us kick off the show today. Appreciate it as always.
Yeah, absolutely. Thank you.
Time to check in now on some of today's top trending tickers. Let's start here with shares of First Solar. They're moving higher. They're posting better than expected quarterly earnings and upbeat guidance. So First Solar reports, Julie, stocks in the green. Q4 EPS, $3.25 a share. That was a beat. Calling for 2024 net sales, it looks like 4.4 to 4.6 billion. Part of what's interesting here is just kind of comparing how First Solar did versus some of their peers like Sunrun. Missed expectations for Q4. Solar Edge guided for current sales that also missed consensus. So it's been kind of choppy here for these names. Yeah,
SunPower just got a new CEO. So that's another one where we saw a little bit of a move upwards yesterday. But there's been a lot of volatility in the space, to your point. Interestingly, also, I was reading a bigger article on the industry from Bloomberg New Energy Finance, which really zeroes in on solar and said U.S. solar installations should grow in the U.S. this year, and that there, of course, is some IRA support for it. But there are still some limitations on it. That said, if you look at First Solar, there's a lot of focus on the backlog here, showing that there's sort of sustainability for demand for its services.
Yeah, First Solar, by the way, higher today, but we should point out, still well in the red both this year and over the last 12 months.
Yeah. Speaking of in the red, let's talk about Boston Beer. Those shares are lower today after the company reported a miss on the top and bottom lines for the fourth quarter. The maker of Sam Adams and other brands also announced that CEO and President Dave Berwick will be retiring in April. That's a big change. The shares are down by 17% here. The company has been sort of struggling for a little bit here, and so there's more discussion of that today. One of the things that Boston Beer, like some other of its alcohol peers, were hurt by was the pivot into hard seltzer, which then sort of quickly fell out of fashion more quickly than the alcohol industry anticipated. And Truly Hard Seltzer is their product there that did worse than expected. They did a little bit better in some other of their categories, but that's one that continues to hurt.
Yeah, I'm looking at just some notes here too. Goldman saying, talked about a lack of near-term growth catalysts. They told their clients they continue to see what they call a negative risk reward, maintain a sell on the name. You look at analysts, how they feel about this one, Julie. I mean, they might like the beer, but most are kind of lukewarm on the stock here. 60% still on the sidelines.
Yeah, definitely. So, and as you can see, it's been a very volatile past year for the company. And then Bumble.
Bumble shares in the red after the company missed on earnings and announced it's cutting about 30% of its workforce. Bumble, tough day to be obviously long this one. The stock hits a record low actually in today's trade. Reported and disappointed, Julie. The outlook for sales, they're not calling for between 262 and 268 million. That is not good enough. The street was closer to 278 million, and of course the layoffs as well.
Yeah, and a lot of the analysts are saying that it's not surprising here, given some of the other signals coming from the industry. According to Yigal Arunian over at Citi, if you look at Match's results, if you look at third-party app data, this wasn't shocking, but it was, quote, a notable step down in growth for the company. And so, you know, there's some questions now about what happens next for the likes of a Bumble after a shrinking like this. By the way, speaking of shrinking, if you recall, I like to talk about the class of 2021, the IPOs from that year, where there was a lot of money being thrown at them and then the big tumble that followed. Well, Bumble was one of those. February 2021 was the IPO, $43 a share.
Wow.
So
yeah.
It's a big come down, obviously.
And it's not just Bumble, by the way, because Rival Match, remember, they also report what we're seeing as kind of disappointing user trends. So it's not to say that people aren't using the dating apps, but maybe they're just sort of evolving as a space and what people expect from them.
Maybe people are getting back to IRL.
Yeah.
That's I can always hold out hope for
but
that
something
kind of
neither
activity.
of us have to worry about. That's
No,
true.
we don't.
No.
Exactly. All right, we're just getting started here on Yahoo Finance Live. Coming up, Mitch McConnell announcing he's stepping down as the Senate's Republican leader in November. We'll discuss the ending of what was a record run and the meaning of that later in the hour. Plus, another full slate of earnings on tap after the bell today. We'll be hitting numbers from HP, Salesforce, and Paramount. Plus, Brian Stasi will catch up with the CEO of HP, Enrique Lores, to take a deeper dive into those earnings. Stay tuned. All that and more when Yahoo Finance returns. Stocks are down across the board today, but there are a handful of names that hit fresh all-time highs. Jared Blickery's here with a closer look at those names. Hey, Jared.
Hey, Julie, I was taking a look at the record highs that have been issued or notched so far this year. So not everything on this list here behind me has notched a record high necessarily today or yesterday. In fact, these are record closing highs. But I went and tallied, number one, who's got the most? That's NVIDIA. That's not a big surprise, up with 23. A smaller company, Boston Scientific, down here on the map, it's up 15.7% for the year. That has 22, and the list goes down from there. But what is really surprising is the distribution of new highs across industries. And let me just get our graphic that I've been preparing. Industrials have almost half of their issues hitting record highs this year, 48%. And that includes names like Packer, like Caterpillar, like TransDigm. Not necessarily the sexy chip names that have been at record highs and really getting a lot of attention that way. But then you go information technology. So tech is number two with 34%, but then it trails off from there. Consumer discretionary, that's retail. Then financials, healthcare, each of those two has over 25% or 1/4 of those stocks at record highs. So the point of all of this, with all the attention that we give NVIDIA and Supermicro and some of the others, there's a lot underneath the surface that's happening that suggests this rally has legs beyond the Magnificent Seven. And let me just show you the year-to-date sector leaders so far. We got communication services that houses Alphabet and Meta. That's up 8.2%. Then financials, then healthcare, and only then tech. So tech is number 4 on this list. And once again, just kind of demonstrating that a lot of the under the radar stuff that's happening in the market probably fuel for the next leg of the bull market, which by all accounts we're experiencing right now.
Jared Blickery with all the market action. Thank you, Jared. Markets facing volatility this week ahead of a crucial inflation report that will guide expectations for interest rate cuts. For more on what to take away from the latest market moves, we want to welcome in now Sam Stovel, CFRA Research Chief Investment Strategist. Sam, it is always good to see you and have you on the show. And I want to start here, Sam, on Bitcoin. And not to get your take on Bitcoin, Sam, I know you're a stock guy, but you know, I look at Bitcoin, Sam, and I see it surging past 60,000. You know, it's up more than 40% already this year. And it's not just Bitcoin, Sam. You know, I look at some of these AI-related names and just the wild moves we see in names like, you know, SoundHound, Supermicro. I'm wondering, Sam, as just a long-time market pro, when you look at these moves, what do you take away from that, Sam? Does it tell you anything about risk appetite right now?
Well, Josh, good to talk to you again. I think it is certainly a representation of the risk appetite where investors are very willing to be chasing these stocks with the expectation that at least those that have earnings are going to be showing improved earnings as we move into 2024 and into 2025. Bitcoin is sort of interesting because it has no earnings. It pays no dividend. It's not used in an industrial fashion. So you really can't say that it's like gold. I also would find it hard to wear. Of course, you'd probably be the emperor's clothes if you did. So basically, I would tend to say you want to be focusing on those areas where you actually have value and can therefore monitor whether you're overpaying or having a good bargain.
Well, Sam, hey, it's Julie here. You know, I definitely have been noticing, you know, all of these big moves that we're seeing in companies that actually do stuff, you know, from an NVIDIA to a SoundHound. Viking Therapeutics yesterday was an example. We're going to talk about that more later in the show. You know, a lot of sort of speculative activity, but it's not from nothing, right? There is some stuff, some there, so to speak. So what does this tell you about sustainability in this market?
Well, there is some there, as you were saying. There are earnings, but I think that what might be happening, at least in the near term, is that these expectations are getting ahead of the reality. I mean, right now, the S&P 500 technology sector is trading at a 56% premium to its average PE on forward 12-month earnings over the last 25 years. On a relative basis, it's at a 25% premium to the S&P 500 500 itself, even though it is primarily the driver of the S&P 500. So a lot of other sectors are in 20% premium areas like communication services, also looking at healthcare and industrials, two groups that continuously notch new all-time highs.
And Sam, you're talking about valuations for different sectors. I'm curious, though, to also get your take on how you're thinking about valuation for just the broad market, because I hear some very smart strategists, Sam, and they say, listen, things to them, and granted, valuation, always in the eyes of the beholder, as you like to say, but they'll say it looks rich, it looks lofty. I'll say other strategists, though, Sam, who say that's just the wrong way to think about it. You can't compare this market to the market 10 years ago or 20 years ago, because different economy, different companies. How do you think about it, Sam?
I think history definitely has a place in valuations, because how do you know if it's undervalued if you have nothing to compare it with? How do you know it's overvalued if you have nothing to compare it with? And that starts to sound like the rationale that I heard back in the late 1990s when the S&P was trading at 60 times forward earnings. Right now, the tech sector is bumping up against 30 times forward 12-month earnings, and that has been a high watermark, a resistance level for quite some time. So we'll have to see whether that breaks above. But right now, I think what we're finding is that things are getting a bit rich, and I would rather see earnings start to improve in order to justify some of these valuations. Actually, a digestion of gains, a correction, probably wouldn't be bad, because I do have high hopes for the market for all of 2024.
And so all the same, 30 is not 60, right, in terms of that price to forward earnings. And so would you use the B word, the bubble word, to describe what we've been seeing?
Well, not yet necessarily. I think there is certainly enthusiasm for the AI stocks, NVIDIA in particular, mainly because the growth potential does seem so wide. We're in the embryonic phase of this AI revolution. So, yes, I think there is an awful lot of optimism or unsubstantiated optimism just based on what the future could hold. But I then just say to investors, don't buy blindly, or if you do, make sure you have a long holding period, because it probably could take some time, if we do go through a correction, to get back to break even.
Sam, I'll get you out of here on this big, important data point tomorrow, PCE, Jay Powell's preferred inflation gauge. What are you expecting to hear there, Sam, and how important is that for the market?
Well, I'm expecting to hear a higher number as compared with last month. So month over month, both the headline and core are likely to be backing up, showing a bit hotter readings. Year on year, however, my belief is that they will continue to show a downward trend. But comparing the PCE with the market's results following the CPI and PPI, I say it's like dropping a ping pong ball on a table. The first bounce is the greatest, and then subsequent bounces are more muted. So with so much time for investors to, in a sense, worry about what the PCE might hold, I think we'll have less of a response than we did to the prior reports.
That's a nice visual as well as audio image for me, the ping pong ball. Sam, it's always great to catch up with you. Thanks a lot. Appreciate it.
Yep, my pleasure, Julie.
Thanks. Senator Mitch McConnell announcing today he's going to step down as Senate Republican leader in November. McConnell also saying he has no plans of going anywhere. His current Senate term ends in 2027. For more, we have Yahoo Finance's Rick Newman. So he's not quitting his job. He's leaving the leadership position. But, this is a pretty significant change.
Oh, yeah. He is the longest serving party leader in the Senate, I think, in Senate history. He's 82 years old. So if he were the CEO of a public company, he probably would have retired by now, unless he was Warren Buffett, I guess. It's in the rest of the world outside of Washington, it's normal to give up your major responsibilities once you hit your 80s. And there's the other thing that's going on here, of course, is that Donald Trump looks like he's going to be the Republican nominee. Mitch McConnell does not like Donald Trump. He basically held his nose when Trump was president and was happy to shepherd through the tax cuts in 2017. But he really objected to a lot of other stuff relating to Donald Trump. And so what this means in a practical sense is that if Trump would happen to win in November, Mitch McConnell is not going to be the guy Trump is calling, saying, here's what I want you to do in the Senate. It's going to be somebody else. So Mitch McConnell will probably be quite happy to escape that duty. But as you pointed out, Julie, he says he's going to serve out his term, which goes all the way until 2027.
And Rick, just switching gears here a bit, we're also getting results from President Biden's annual physical. Of course, Biden's health is an issue in this election. What can you tell us about that?
Well, Biden's doctor said he's an elderly man with a poor memory. Wait, I'm just kidding. That was the special counsel investigating Biden for classified documents. What Biden said today is that the results of his physical were the same as they were last year. And last year, the doctor said Biden is a vigorous and healthy 80-year-old man. So I guess Biden is now a vigorous and healthy 81-year-old man. Usually they'll put out a summary report, which I think if it's not out at this point, it'll come later today. But at least Biden's doctor seems to think he's fit to hold the office of president.
Something tells me the people who don't have a lot of faith in Biden's health won't put a lot of stock in the doctor's report. But, who knows, Rick?
Right.
We also had some more legal news on the President Trump front, a report that he might have to sell property to meet that $454 million payment. And this is a little complicated, right? Because there is a bond that he offered to give him a little more time, if I'm understanding it correctly.
Sort of. So Trump has appealed this court outcome, and this is not one of the 4 criminal cases. This is a civil lawsuit that has been going on in New York State. It was a lawsuit brought by the Attorney General of New York State. Trump lost before a judge, and the thing that happened recently is Trump lost last year, and then the judge recently said, well, here are the penalties and the fines you have to pay. And that amounted to, including interest, I think $454 million, just a huge amount of money. And that's on top of $5 million and then another $83 million that Trump is supposed to pay the writer Jean Carroll in that sexual assault and defamation suit. So Trump owes more than $500 million. And even though he claims to be a billionaire, his wealth is not in cash. It's almost all in assets such as buildings. So Trump is appealing the ruling on the $454 million, but he does have to put up a bond supposedly equal to that amount of money. Now, what Trump has said is, what if he just puts up a bond that's worth the equivalent of $100 million instead of the whole 454? We're not sure what the judge is going to say about that. And this is not a surprise because people who've looked at Trump's finances say he does not have this much cash sitting around. And then he may actually have to liquidate assets in order to if he has to pay this entire amount of the fine. So that means Trump would probably have to sell properties. And I think he's indicating, that looks like what might have to happen here.
Rick Newman, always love having you on the show. Thank you for joining us.
Bye, guys.
Shares of Lifetime Group, they are rising today after reporting strong sales and membership growth in its 4th quarter. We're going to speak to the CEO of Lifetime about the latest numbers on the other side.
Shares of Lifetime Group getting a major boost today after reporting strong sales and membership growth in its fourth quarter. The company, which operates more than 170 athletic clubs across 31 states, is forecasting more strength in the year ahead. And joining us now is Bahram Akradi, who is Lifetime CEO. Bahram, thank you for being here. So as you look at the outlook here, and as you look at increasing membership, increasing the number of clubs as well that you all have, what to you is the sort of primary growth driver? What need are you fulfilling amongst people that's not being filled perhaps by the gyms that are out there?
That's a great question. So Lifetime has always focused at the higher end of a leisure brand. And then we focus being that as much a subscription business as possible. Very much like what we internally look at is Vail Resort. Much like them, we have assets that they're not duplicable. There's no way to the 130, 40 of these 170, there's no way to replicate them at this point. We have another 60 to 70, 80 clubs in the pipeline. So it's a high-end experiential company. Our members are using the club about 13 times, 12 and a half, 13 times per month. It's a deeply used subscription. The retention rates are at all-time high. So what we focus on is revenue, the margin from that, and we're right about 24% EBITDA margin, and we're looking at the retention. And as we are able to see right now throughout the year forecast, this year looks like we will have the best retention of membership in the history of the company, which ties in directly to the highest member visits per month, which we're very happy with all the metrics that we are seeing right now.
And Bahram, another big theme, investors are certainly very interested in, and we talk a lot about here, those new weight loss drugs, the GLP-1s. How is that impacting your business? How are you all capitalizing on that trend?
Yeah, it's in fact, at first when I heard that this was like people thinking this is going to hurt the club business, the exercise business, it's actually contrary. The people who are taking the initiative to go ahead and spend $500 a month, $600, $1,000 a month on these drugs, they really want to look good. They want to feel good. And there is no way to have the complete answer without regimented weight training exercise to go along. If they don't do it early on, after a while, they realize they have to do it. Otherwise, if they're having good coaching, they're getting started with it. So we haven't seen any negative impact. In fact, if we see anything is positive, we expect that to be the case going forward. Now, Lifetime particularly is in a great spot because we are the higher end provider of this luxury facilities. And therefore, this customer that is going to come to us is looking for a higher end experience, some more professional trainers to basically address what they need. And we are sitting perfectly to benefit from this. And then we have launched Miura, which is our own version of addressing the peptides, the weight loss, the longevity, all of that. We have one location that's going fantastic. And then the plan is the rollout of that in every market across the country.
Bahram, who do you consider to be your main competition? Is it, is there another gym that you feel like you're sort of competing with, or is it other activities? How do you think about that?
Yeah, not really. It's really more, we look at the companies that they're inspiring. They have been around for, decades, like Lifetime has. The only company that right now is in my head and my team's head is Vail Resorts. We have a lot of respect for them. They were the innovator in trading many things go to subscription instead of a day-by-day use. They have a moat. It's difficult to replace those assets. Lifetime has similar. The advantage we have is that we have a total addressable market that is still 3, 4, 5 times higher than our. So we have a lot of growth opportunity with great returns. So the company that we internally look to see what are we going to do? How do we compare ourselves? How do we catch up with that revenue and that EBITDA is Vail Resort.
And Bahram, I want to get you out of here on this. Besides the clubs, the gym, lifting, working out, Bahram, another big part of your kind of broader strategy. It's housing, it's real estate. Walk us through that.
Okay, so when we started with this almost 7-8 years ago, when we put Lifetime in a 1,000 apartment unit high rise, we saw improved in rate for the apartment, per square foot for the apartment. We saw retention being significantly better, which is a key factor for the apartment. And of course, the ramp. All three major KPIs are being affected dramatically with Lifetime's 150 billion impression a year, which is massive, and then what we bring in as an amenity. So we developed our own development in Las Vegas. That is 150% per square foot of the market on rent. It ramped within a year to full, and then we have a retention rate unheard of in the industry. So if you're building an apartment building and you have the opportunity to have it branded Lifetime, our vision is to make this like Four Seasons or Marriott brands, where the developers who want to develop that will basically brand it Lifetime. We come in, we bring in the expertise in the activation of that facility. And my vision is a village, Lifetime Work, Lifetime Living, Athletic Club, all the services, that this program is naturally and intuitively environmentally friendly, because it just reduces the need for people to drive.
Bam, it was great to have you on the show today. Thanks so much for taking the time to join us.
Thank you so much for having me.
This is the Tesla Roadster. It was unveiled in 2017, and the company promised it would be the fastest car ever made, but it never made it to production until now, it seems. After 6 years, CEO Elon Musk saying the long-delayed electric sports car will begin shipments next year. Praz Sumaranian has the details.
I can't help laugh my way through that intro. It's coming now. It's coming now, Praz. Really? Is it really coming? That's a little credulous.
He
I don't know.
says it is, but just to rewind a little bit, 2017, right? This is 5 years ago. We saw this thing roll out at an event, and then haven't heard much since until 2022, when Musk said at the Giga Rodeo, when they opened up the Austin factory, that it's coming. It's going to come in 2023. Right, and they reopened reservations, and we'll talk about that. But basically now we see Musk tweeting late last night, it is coming. They basically, production design is complete. They're going to unveil the car later this year, like you said, Josh, and then planning for sales next year. Now, says again, a 0 to 60 time less than a second, kind of insane stuff here. But again, we heard this 2 years ago, we heard it 5 years ago. Is it actually going to come out? Deposit holders, some had put down $50,000 with no interest, right? That's refundable. I'm sorry, $5,000 refundable. Other people have put down $250,000 for the Foundation Series to get that car. So.
Well, I hope they get it eventually, right? I mean, this reminds me of the Cybertruck a little bit as well, which did it sort of come out.
Yeah.
Right?
And eventually, right.
Yeah. It's interesting timing because, of course, BYD came out with its own supercar earlier this week. Is that a coincidence that we're now getting an update on the Roadster?
I wrote a piece on it's going to come out just in the next few moments. But basically, yes, I kind of allude to the fact that it's interesting that these tweets came out late last night. We talked about BYD's U9 supercar, right? It's going to cost $230,000, on the same price as potentially the Tesla Roadster. Scissor doors, 4 motors, all these pretty cool stats. But only a couple months ago, NIO also said that their EP9 hypercar is going to cost $3 million US, 1,000 horsepower, interchangeable batteries, all this sort of stuff. The Chinese supercar makers are sort of coming on strong here, and it seems like maybe Musk kind of had to cough up more details because he felt the need to, because these cars are going to come on the road later this year, the Chinese cars. So in China, but not necessarily in the U.S. But still, competition nonetheless.
Right. If you're a Chinese buyer, are you going to wait for the Tesla Roadster, or are you going to buy one of these other ones?
I want to quickly just say something real quick. Yes, it is a $5,000 deposit, not a $50,000 deposit for.
Oh, that's a lot lower.
Yeah.
But still.
Just wanted to correct
that.
It's
not nothing.
I mean, it's interesting probably because, listen, I think that's a beautiful car. The lines on that car are beautiful to me. But I would say, like, $200,000, when you find yourself competing with, like, a Lamborghini or Ferrari, that's a small market. I mean, ultimately, that doesn't move the needle for Tesla or the EV market, right? I mean, what have we talked about so much on the show? What's one way to reignite growth here? It's not the $200,000 car. And again, Gorgeous car. But ultimately, you need lower priced EVs, right?
Yeah, I think these are just halo cars that bring people in. Like, they have the Optimus robot in some stores to kind of bring people in. Same with the Cybertrucks in a lot of the marquee Tesla stores to bring people in. So that's like some of the thing that kind of draws you in. But you're going to buy the Model Y or the Model 3, maybe the X or the S as your actual car. Quickly, I want to again clarify that it's a $5,000 deposit. But then within 10 days, you got to cough up another $45,000 for a $50,000.
So it is effectively a $50,000
for a
deposit
car
that people have put down.
Yes, and the car when 2017 it was said to be a $200,000 MSRP and $250K for that Founders Edition. Sorry about that. Want to get that clear.
That's okay. We'll see. I mean, it's not even out yet, so there's a lot of confusion, I guess.
Yeah. Well, why do we care, right? It doesn't matter. It's going to change tomorrow. Who knows, right? We'll see.
Wait for the tweet. Praz, thank you. Appreciate it. Stay tuned. More Yahoo Finance is coming up as we count down now to the closing bell. Shares of Viking Therapeutics extending gains after data from the company's latest weight loss drug trial showed greater efficacy compared to competing products from Eli Lilly and Novo Nordisk. Joining us now is Justin Zelnick, BTIG Director, Biotechnology Research Analyst. Justin, it is great to have you on the show. And Justin, you're just the right guy to ask this because I'm interested, Justin, as someone who really knows this space so well, what you kind of made of Viking's mid-stage data. I mean, obviously investors were very, very excited about it, but I'm interested to get your take, Justin, what you made of it, and what you think we're going to learn from the late-stage testing.
Absolutely. Well, thanks so much for having me on. It's been a great run for Viking Therapeutics here. The stock is up over 400% year to date. and it's been up about 140% since the company presented outstanding results from the phase 2 venture study of VK2735 in obesity yesterday morning. The results exceeded both our expectations and the street's expectations. This was a 13-week study, and we were expecting 7% weight loss as our base case scenario and over 8% as a bull case scenario. And they showed almost 15% weight loss, which is superior to both marketed drugs in this indication, both Novo Nordisk's Wegovy and Eli Lilly's Zepbound, as well as developmental drugs at the same time point, offering another competitor to the current commercial duopoly. So, moreover, we were also extremely impressed by the company's safety profile for this drug. Most of the GI side effects were mild to moderate. They occurred in the first week of treatment, and those side effects resolved as time went on. And the weight loss continued to progress throughout the study without plateau. So we'd expect that continued weight loss will occur here from the current study. And if the current rate continues, we could see greater than 25 or 30% weight loss after about a year.
So Justin, we know this is experimental thus far. And for those lay people among us, who is almost everyone, except people like yourself, is this a different technology than a different platform than the GLP-1s? And how do these results compare with the results that we have been seeing from that class of drugs?
Absolutely. So the GLP-1s is Novo Nordisk's franchise, that's semaglutide. This is a dual agonist, so more like Eli Lilly's tirzepatide, which they market as both Mounjaro for type 2 diabetes and Zepbound for obesity. So this has actually two targets, both the GLP and the GIP axis, which offers more potency and more efficacy than the monoagonist on GLP-1 alone. What's so impressive about this data is this compound actually caused more weight loss than Eli Lilly's dual agonist tirzepatide. So they saw, about a 7% weight loss around this time point, and Viking actually doubled that. They showed 15% around the same time point of 13 weeks, and that's why investors are so impressed here.
Justin, I want to get you out on this. When you think about a Viking, is it a potential takeout target, Justin, in your opinion? And if so, what is there any thoughts about who the acquirer could be? Is there a company out there, maybe a large cap pharma name, where it would make sense financially and strategically?
Yeah, there's been a lot of speculation on M&A in this name. Obviously, it's a name that's of high interest to big pharma players. Look, the GLP franchises are doing over $4 billion a quarter in sales. Tirzepatide's doing over $1 billion in quarter. So this is a high interest space that pharma's looking at. And you could imagine that players such as Pfizer, who had an asset, they no longer are continuing with that asset, are paying close attention to this space currently.
Yeah, as are we all. Thanks so much, Justin. Appreciate it.
Anytime.
Coming up, it's the closing bell on Wall Street. We've got you covered on all the market moves to wrap up the trading day, as well as another full slate of earnings on tap. We'll be hitting the latest numbers from Salesforce, Paramount, HP, all of that in the 4 p.m. hour. Plus, Brian Sozzi will catch up with the CEO of HP, Enrique Lora. Stay tuned. We've got all that and more when we come back. There's the closing bell on Wall Street. So let's do a check of where things ended up. All week long, we've been playing the PCE waiting game, it feels. We did get some Fed speak, including that from John Williams today, who said we still have a ways to go before we get to the Fed's 2% inflation target. In advance of that number, which comes out tomorrow morning at 8:30, we've got the Nasdaq down more than 0.5%, the S&P pulling back by about 1/5 of 1%, not quite, and the Dow off by 23 points. That's not even 1/10 of 1%. Communication services and tech down the most today, as reflected in that Nasdaq drop that we saw. But overall, not huge moves that we have seen this week in advance of that report.
Stocks and holding patterns, Julie noted ahead of tomorrow's big PCE report. Jared Blickery is here with a look back at today's action. Jared.
That's right, Josh. Some negative price action today in the majors and also the Russell 2000, which was leading to the downside today, down 0.8%. The Dow just barely off about 0.6%. And when we look at today's winners, real estate by far and away the number one, up about 1.3%. Then you have consumer discretionary, which, by the way, is the number one sector this month. And then financials, industrials, materials, utilities, all of those round out the top row. Communication services takes the bottom spot. That was down 0.7%. That has Alphabet and Meta in it. And you can see these two stocks right here, down 1.8% and 0.6% respectively. Among the mega caps, only Microsoft ended the day just barely positive, and then Tesla up about 1.16%. And then just taking a look inside the market here, volatility has been on the wane. Here's the VIX over the last 6 months, definitely off the bottom end of the range. We usually get a little bit of a spike in February, but it was very, very muted. Have not gotten what seasonality predicted might be a little bit of a pullback or a break. We've just been hitting these record highs. Now here's the 10-year T-note yield that is down 4 basis points. I've been pointing out that it's kind of been in a flat line, or you could consider it consolidating or coiling for a move. Nevertheless, it has not made that move just yet. If it does break to the upside, that could be a leading indicator of some potential weakness, but has not happened yet. Now here's today's leaders board. Only Bitcoin, and that finally topped 60,000. GBTC is my proxy. That ETF up over 5%. We also have defense stocks, ITA, that's up about 1.4%. Korean stocks, some bond action there, but really not a whole lot of winners. To the downside, the biggest loser was KWEB. That is a Chinese internet ETF, and you can see on our China heat map, this is Nasdaq Golden Dragon Index components. Lots of red on your screen.
Thanks a lot, Jared. Appreciate it. We've got earnings from Salesforce coming out right now. The company's fourth quarter earnings per share coming out 2 pennies above what analysts had been anticipating. It looks like fourth quarter revenue a little bit ahead of estimates as well, but not by much. $9.29 billion versus the $9.22 billion that analysts had estimated. Also, it looks like the company's first quarter revenue forecast, the midpoint of that is below estimates. $9.12 to $9.17 billion is what Salesforce sees in the first quarter for revenue. 9.16 billion is what analysts had been anticipating. And as far as I can see as well, the full year revenue forecast for its fiscal 2025 is below estimates as well. Salesforce expects as most $38 billion in revenue. $38.62 billion is what analysts had been anticipating. That said, the earnings per share forecasts are better than estimated for the first quarter and for all of 2025. So let me summarize, because that was a lot of numbers, I realize. I think the bottom line here is that the revenue forecasts for the first quarter and full year are short of estimates. Earnings forecasts are above estimates, which reflects here the cutting that we have seen, the pullback that we have seen happen for Salesforce. But I'll be really interested to see what the sales forecast, Josh, indicates about demand here. I'm sure that we'll be getting some questions on the call about demand. You know, is this a company that is trying to cut its way, or is successfully cutting its way to beating estimates at the same time that demand is flagging?
Yeah, I do see another interesting data point. In 2025, their adjusted operating margin forecast of about 32.5%. That's already a touch higher than at least some of the estimates I was seeing on the street. But listen, the stock is down about 6% after hours. Obviously, this is another name that had this tremendous run into this print. It was up about 80% over the past 12 months. But I think you're right. Obviously, a lot of immediate questions about the forecast, the guidance. What does CEO Mark Benioff kind of see in that general environment for enterprise demand right now, Julie? That'll be a big focus on the call. Remember, they also did raise prices. That'll be another question on the call. What kind of impact is that having on Benioff's business? And of course, adoption demand for the company's so-called Einstein AI platform as well.
A couple of other interesting and important things I should note here. The company is starting its first ever quarterly dividend. That's going to be 40 cents a share. It is also increasing its share buyback authorization by $10 billion. Those are very interesting, especially given the fact that we are not seeing a more positive reaction in the stock here today. A bit surprising, perhaps. I don't know what the expectations were for the numbers for the dividend and for the buyback here, but that's something that Mark Benioff highlights in the statement here. He also, of course, calls out the Einstein One platform, which is Salesforce's AI-related product here that it has been coming out with updates on. But again, going to be some questions on the call about demand. And something else to mention is that Salesforce had been under some activist pressure. So all of this at play when we're talking about the company. You also in the past have pointed out how well the stock has done.
Yeah.
So that's something to keep in mind as well as we look at this reaction, which really does seem to be tied to that sales forecast.
For sure. Moving on, for more on today's market moves, let's welcome in Steve Sosnick, Interactive Brokers Chief Strategist. Steve, it's good to have you on the show. And maybe to start, Steve, today's market action, we did see, major averages, as Julius pointed out, they ticked lower, and we are kind of in this holding pattern right here for that PCE report tomorrow. But of course, listen, the rally we have seen, Steve, we've come up hard and fast here. I'm interested just to start kind of your broad view of, where we're at, Steve, and where you think we're headed with the stock market.
Hi, Josh. Great to join you this afternoon. I think what we've been seeing recently is a bit of consolidation, and that's not something to be concerned about. I'll actually argue it's on the healthy side. We can't just have these situations where markets just rocket higher every day or every week. You need to have a little bit of backing and filling. You need to take some profits here and there, and that's okay. And I think that's largely what we've been seeing. This is still sort of the aftermath of the post-NVIDIA run up. But what the sell-offs that we've seen since then have been what I would consider just garden variety back and fill or consolidation, pick whatever term you'd like, as opposed to something that's fundamentally unhealthy. We covered a lot of ground in a short period of time.
Steve, I don't know if you saw the morning brief that I wrote about today, where I wrote about sort of the return of the FOMO trade or number go up. The idea that you look at the Yahoo Finance trending ticker page on any given day. Today it's Bitcoin and Beyond Meat for that matter. You have these, big swings in the market. Doesn't feel quite meme stocky per se, but it does feel like there is this enthusiasm. What do you make of that phenomenon that we've seen a return of?
Hi, Julie. First of all, I read the morning brief every morning,
Oh,
so I did see that. Even though I was traveling today, I did catch it before I got on the plane. So I've been calling this weaponized FOMO, actually, and I coined the term sort of as we went into the end of the year, where there was just this rush. Institutional investors had to be invested. From an institutional point of view, remember, if you don't want to be the underperforming institutional investor, you don't want to be the worst performing institutional investor. That's real fear. That's risk. That's career risk. From an individual point of view, which I think is starting to spread out here, FOMO to me is actually greed, because if I'm not the best performing individual investor, what's the difference? I can get a little jealous that that the guy next door is doing better than me, or my friend has made all kinds of money doing something. But ultimately, it doesn't really affect my life, if I'm doing okay, but someone else is doing better. But it's human nature not to like that, and I think we're really starting to see that element creep back in a big way. And I think that's why you're seeing when you're seeing stuff move, and I was going to say stocks move, but it's really stuff because Bitcoin is stuff, if that. And that's why some of these moves have been so ferocious, so tremendous, because people do not want to be left out. And certainly NVIDIA's move epitomized it. But you look at some other stocks like SMCI, which have been on parabolic moves for a while and then pulled back. This is to me is pure it's pure FOMO because it's not just about doing better than, on a fundamental basis.
And Steve, I want to follow up on that because the last time that we really saw this was the period of stimulus checks. It was a period where money was much easier, so to speak. That is, interest rates were much lower. Now we're in a period of much tighter financial conditions. Yes, people's incomes have gone up, but inflation has gone up as well. So I'm also wondering kind of where the money is coming from in a way compared with other periods that we have seen like this.
Yeah, this is an interesting one because, yeah, you're right. This is a sort of easy money type of market, but we don't have easy money. And as a matter of fact, I wrote a piece last week called "Dude, where's my rate cuts?" Because we went from this motif of having the Fed acknowledging that they would cut cut 3 times, which is what the market was sort of predicting before December, and then the market said, "I see your 3, I raise you to 6 or 7." Now we're back to 3 for 2024, but stuff is proceeding as though the Fed was still actively cutting rates. Now, some of the concentration has been in stuff where they're delivering earnings, and I'll point to NVIDIA again and some of the other AI-related stocks. But we're seeing it in all kinds of other stuff. The idea that, let's say, a Beyond Meat today, which the numbers were good, but were they 33% better good type of thing? No, that's a lot of we're going back to this idea of preying upon the shorts. We're seeing a lot of activity in sort of smallish cap stocks that that might start the day at 2. We literally had a situation like this where I don't even remember what name it was because it was a small position that got left on the book basically. Some stock opened at 2, closed the day before 2, opened at 7, and then was like down at 1.5 afterwards. Some small micro cap stock, and I wish I could tell you what it was. I honestly don't remember. But this is the stuff that happens, and this is the kind of kookiness we're starting to see again. And that is a concern because this is not the type of easy money environment where this stuff tends to happen or can be happening quite so easily.
And Steve, you all actually break down the 25 most traded stocks on the platform. Any surprises there, Steve?
Lately, not really. It's really been AI. It's been AI enthusiasm. Tesla has perpetually been the most active stock on the option on the IBKR platform. Lately, it's been NVIDIA. That should not come as a big surprise to anybody. AMD is always toward the top. Guess what? AMD is around the top now. It's SMCI. It's things like that. Lately, we've seen a lot of activity in Marathon and Coinbase. Again, not all that surprising. We're seeing it in TQQQs and QQQs. So for the most part, we haven't had a ton of surprises recently. And I guess that goes back to what the market has been telling us. There are some times where you get some oddball names, but right now it's been pretty much, if I gave you a few minutes and a pencil and paper, even if you hadn't seen them, you'd probably get, most of the top 10 pretty quickly.
Steve, thank you so much for joining us today. Always appreciate it.
My pleasure, Josh. Talk to you soon. Take care.
Coming up, Paramount earnings have hit the tape. We're going to break down those on the other side of the break, joined by an analyst later in the hour. Plus, HP is set to report soon. We're going to break those numbers down as well. And our very own Brian Sozzi catching up with the CEO of HP, Enrique Lores. Stay tuned. More Yahoo Finance coming up. Shares of Paramount slightly lower here after missing expectations on revenue in the fourth quarter. Let's talk about these results real quick here, Julie. So Q4 sales, they did drop 6% to $7.64 billion, and that is a miss, though earnings of 4 cents, it looks like, ex some items. That was better than what the street was looking for than consensus. Subscribers to the streaming service, Paramount Plus, 67.5 million. That did increase about 4 million from the previous quarter. That beat estimates. Revenue in that services grew to about 1.87 billion. And yes, they did post a loss there, but it doesn't look like it was as much of a loss as analysts had forecast. You can see shares are down a bit here in the after hours.
Yeah, and as our Alexandra Canal, who covers the company in more detail, pointed out in her write-up on the earnings, ad revenue down, linear ad revenue in particular, down 15% year over year. That was worse than estimated. But really, this was a mixed picture because if you look at its direct-to-consumer losses, according to Ali, $490 million, that's narrower than analysts had been anticipating. So that's something to keep in mind as well. Subscribers to Paramount Plus, 67.5 million, which was also ahead of estimates. So kind of, again, mixed picture here. As we know, though, and as we've been talking about, really what investors want to know is there going to be a sale?
What is the future of this
who
company?
is it going to be? And is it going to be the sale of the parent company, Skydance, or what is this all going to look like here? And I think that National Amusements, Skydance is one of the companies that was talked about as a buyer. I got all of it alphabet souped in my head here. But in any case, I think that's really what investors are waiting to hear about.
Yeah, we know they've been weighing offers, different reports of who might be interested in kicking the tires. This stock has been hammered. I mean, heading into this print, it was down about 50% in the past 12 months, edging lower, at least initially here in the after hours.
Yeah, let's also take a look at shares of HP Inc. That company's revenue missing estimates here. $3.19 billion was the first quarter net revenue number. $13.58 billion is what analysts had been anticipating. And the company's second quarter forecast of adjusted earnings per share of 76 to 86 cents compares with the 82 cents that analysts had been forecasting here. But it seems like that sales miss is to blame for the drop in the stock. In addition to that, first quarter free cash flow at only $25 million versus the $1 billion that analysts had been anticipating. That's a bit of a head scratcher. So we'll dig into that a little bit further. But effectively what you have here is that PC sales are still relatively weak here, so that revenue figure is down 4.4%.
Yeah, it'll just be very interesting to see what the company says about the PC market now and looking ahead. What's the demand environment like? What's pricing going to look like? There are some folks who've been betting on a PC recovery.
Yeah.
And remember, of course, you got to talk printing. Ink and toner, I know, not the most riveting topic, Julie Hyman, but critical for this company. So also what the company sees there, print consumer, print commercial will be very important.
It looks like printing was kind of in line with estimates. It's where the actual PC sales came in that disappointed.
Yep. For more on this, Yahoo Finance's very own Brian Sozzi did catch up with HP's CEO Enrique Loris to go over the numbers.
Enrique, earnings came in fairly well, and I think that says a lot about how your team continues to manage costs. But talk to us about why sales in the computing business and the printer business, why did they decline in the quarter?
I think I would say we had a solid quarter in Q1, and both the decline on revenues was really driven by what we see from a market perspective, but internally we are executing well. We grew share in PCs, which is the major driver of revenue. So from an execution perspective, we do well. I think what is also important to highlight is that we continue to expect the PC market to grow in 2024. We expect the second half of the year to be stronger, and we are well positioned to ride that growth when it will come.
What is it about those market dynamics, Enrique, that you just mentioned that is putting pressure on volumes of PCs and printers?
Well, what we have seen is that demand has slowed down. I think it's driven by the cautiousness that we see in corporate customers and by the many products that were bought in the past by consumer customers. I think this is what is the key thing that is behind what we see on the market. When we look at the future, we expect to see recovery on the commercial side and also a strong seasonal performance on the consumer side.
What gets that commercial side going back in terms of sales? What gets that growing in the right direction?
We think there are multiple factors. One is whatever is the evolution from a macro perspective, But then if we think about the specific PC category, Windows refresh is going to be a major driver of that. You know that there is a discontinuance on some of the previous OSs, so that will drive growth. It has happened all the time. There will be some impact on AI PCs, so we think it will be modest in 2024. And then there will be a positive impact on prices, a combination of mix, and also as some of the commodity costs will increase, we will see an increase of prices.
In terms of the AI PC, and this is something you and I have talked a lot, really a lot about over the past year and a half, what does the ramp of uptake look like on those PCs amongst consumers?
First of all, we continue to be very excited about the value that AI PCs are going to be bringing to customers, because they will enable them to do many things that they cannot even dream about doing today. We think that the ramp is going to take about 3 years. Our projection is that 3 years after launch, the penetration will be between 40 and 60%, and therefore the impact in 24 will be smaller, but we will see it gradually growing in 25 and in 26. The key thing is not only going to be the availability of hardware that we will be driving, but also to make sure that applications take advantage of the new functionality that PCs will be having. And this is the work that we are doing, working with many of the key application developers to make sure they understand the possibilities and they integrate them in their solutions.
Within, there's a lot of focus right now, of course, on AI and hardware devices, but how important, Enrique, is it that a lot of companies are making more chips? And how important is domestic manufacturing of chips in the United States to ultimately bring some of these new AI PCs, AI cell phones to market?
We think that during the pandemic, we realized how important resiliency was, and to have a more resilient supply chain, whether it's chips or hardware in general, having a more distributed manufacturing network is important. And this is why we were very supportive of the CHIPS Act, to make sure that we saw chips factories being built again in the US, because we think that for the long term, it's going to be really critical to have those capabilities in the country.
How big or how much of your supply chain is still in China?
China continues to be an important manufacturing platform for us, but again, similar to what we were just talking about chips, we know we need to diversify, and we are increasing our manufacturing capabilities and capacity in other parts of the world. We are doing that in North America, we are doing that in Southeast Asia, in other countries, to make sure that we have a more resilient model going forward.
Pretty interesting week, Enrique, with Google CEO or Alphabet CEO talking about wrong inputs coming out of their AI models, and now they're really scrambling over there to fix it. How concerned are you about the information that an AI PC might put out because of these models?
I think as we look at AI, we need to look at it from two perspectives: the value and the productivity improvements it's going to bring, but at the same time, we need to be careful about the bad information and what impact this may have. And we are really supportive of all the actions that are being taking place in different parts of the world to make sure that regulation is put in place to really make sure that drone behaviors are under control.
What does it feel like, Enrique, to be running a legacy tech company like an HP, and just an iconic American company of PCs and printers at a time where there's so much attention and valuation, our valuations are exploding for a lot of these software players and these chip players and these up-and-coming players in AI that nobody has really heard of. What do you think about that?
I remain very optimistic about the future of the company. I think the changes that we see happening in the technology space, driven by AI, the changes that we continue to see in how people work, driven by hybrid work, are opening a tremendous opportunity for HP, and we are driving strong innovation in all these fronts to really be able to capitalize and to lead some of these changes. So as you know, I have been in the company for a very long time. I am more optimistic now than I have been in the many, many years I have been before.
Enrique, look, you still look 27 years old. You know, I will say that. I will just say that publicly. But actually, before I let you go, on that point, you have seen a lot of cycles. You've been doing this for a good bit. You've lived through the dot-com crash and the financial crisis, and now this AI situation. What's your read on valuations? You think investors investing in AI are wrong, or are they just right to be as enthusiastic about some of these companies that in some cases they've never even heard of before?
I think when I look back at the last 30 years, there has been technology discontinuities that have created a lot of value. Think about the dot-com evolution 20 years ago, the mobile changes 10 years ago. I think AI is a similar disruption that is going to enable the creation of significant value that today we really don't understand how it will come, but I'm sure it's going to happen, and is really what opens the opportunity for all of us to be optimistic about the future.
All right, I'll leave it there. HPCO Enrique Lores, always nice to see you. Thanks for giving us a few moments of your time. We appreciate it.
Thank you, Brian. Great to be here.
All right, thanks so much. All right, Julie, Josh, back to you.
Thank you, Brian Sazi, and of course, HPCO Enrique Lores. On the other side of the break, we're going to take a deeper dive into Paramount's earnings. Plus, the great American road trip goes electric. What to consider when traveling in your EV. It's coming up next.
Shares of Paramount, a little changed on the heels of its mixed earnings report. The company reporting a better than expected profit of 4 cents per share, but revenue did miss estimates. It was down 6% year over year. Let's bring in Geeta Raghunathan, Bloomberg Intelligence senior media analyst. Good to see you. You know, I know we're looking through the earnings here, but let me just get the elephant out of the way ahead of time, Geeta. At this point, is all investors care about sale news from this company, or are they still paying attention to these earnings?
I mean, fundamentals do matter, Julie, but obviously not as much for this company as, those M&A rumors. And we've had plenty of those over the past few months. So at this point, I think, investors kind of really trying to see what are, the plausible M&A exit options for this company. And those seem to be actually shrinking as each day passes.
Is there, Geetha, when you think about potential acquirers, are there names that you think, yes, that could make strategic and financial sense?
So, the big name, obviously, that came up maybe about 2 months ago was Warner Brothers Discovery around Christmas time, kind of entertaining this thought of combining, the two companies. And of course, it makes a lot of sense. They both have heavy exposure to TV networks. They could extract a whole lot of synergies. There's obviously a lot to be said there. But then you kind of look at it, I think investors really did not like the idea at all. It would have been a financial death sentence for both of these companies because debt is a huge problem actually at both of them. Paramount has over 16 billion. Warner Brothers Discovery has close to about 45 billion. Investors did not like the idea at all. We yesterday actually got the news that Warner Brothers Discovery is kind of walking away from that, looking at that deal. So yeah, we have had some news from, some other investors. Byron Allen has been one who's actually come out with an offer on the table. I'm just not sure anybody is taking him very seriously. And then of course there is, kind of the one player who seems to be interested is Skydance Media, which is a studio, and I think they're really interested in the Paramount studio, which is absolutely a world-class property. But the problem is again that they are not interested in acquiring the TV networks business of Paramount, and I'm not sure whether management will be open to kind of selling pieces of the company as opposed to the whole company.
Well, let's talk about the pieces of the company for a moment here and what we learned in these results, which is that traditional ad business on those traditional networks not doing so hot. The streaming business a little bit better than estimated, both in terms of the numbers of subscribers and the magnitude of the losses here. So leaving aside a potential sale for a moment, assuming a sale doesn't happen, let's pretend a sale's not going to happen, kind of where do they go from here with that dichotomy in the businesses?
Yeah, so really the biggest question right now, I think, for investors is the progress on the streaming front, or is the revenue and profitability on the streaming front ever going to be able to make up for that shortfall on the linear TV side? And the answer so far has been no. But there might be some green shoots here. So one of the things that you pointed out, Julie, which is, the one thing that everybody is looking at very closely is the magnitude of losses. And those did come down. So yes, they are making some progress. And the bigger news, or the bigger positive, is that they actually guided to Paramount Plus turning profitable in 2025. So that again is definitely a piece of good news. Again, is that going to be enough? Not so sure, but it's definitely progress in case, obviously the sales, the sale doesn't happen. So yes, they are making some progress, but you're absolutely right. The TV business is definitely being hit very, very hard. Ads were down 15%.
Geetha, always appreciate having you on the show. Thanks for your time and your insight today.
Thank you so much, Josh.
Electric vehicles are making the great American road trip a bit more complicated. If you're a new EV owner thinking of hitting the road this summer, you've got a lot to consider when planning long-distance travel. Joining us now is part of Yahoo Finance's Travel Guide 2024 Industry Insights, Yahoo Finance's Akiko Fujita.
Hey, Josh, well, the good news is that if you are planning to go out with an EV, it's going to be a lot cheaper for you. You don't have to pay for gas. There are many public stations, charging stations that are free. The bad news is what you just said. It's going to be a lot more complicated in trying to plan out that trip. So let's try to break down what exactly you need to consider. The first one is your car. If you've got an EV at home, you've already made that decision. But if you're looking to rent, you do really want to think about the range of these cars. And we've picked out some models for you. The Model Y from Tesla, obviously, in terms of what we're seeing, at least with some of these rentals, certainly has the most range, at least in the mid-tier EVs. We're talking about 260 miles on a full charge, up to 310 miles. You've got the Ford Mustang Mach-E Select. 250 miles is where it starts at. And then Rivian R1S dual motor AWB, 260 miles is what we're looking at there. Now, the key part of that travel experience, the road trip, is going to be how you map out that route, because you want to make sure that you've got plenty of charging stations along the way. And if you're in place like California, it's not going to be as big of an issue. If you're looking for a cross-country trip, you're certainly going to want to be looking at that. And there are two apps that you can be looking at. The one I recommend is PlugShare, and that is a user-generated app where users around the country that drive EVs are posting where those charging stations are. You can find exactly how many chargers are in individual locations, how many are working, although I will warn that that's not always accurate. You can, of course, also find information on Google Maps, which tells you where some of those key chargers are, Julie.
And then, okay, so you've mapped out your trip. Say you're driving cross country. How long does it take to actually charge? And of course, there are different kinds of chargers, right? There are ones that are faster and slower.
Yeah, I mean, that is probably where you're going to spend a lot of time in trying to get that car charged. So let's show you the level of chargers that we're talking about. Level 1, of course, is the slowest charger that's out there. You get about 2 to 5 miles per hour. So you're going to want to try and avoid that. Level 2 is the most common. It counts for roughly 70% of all public chargers. You get about 10 to 30 miles per hour. And the one you really want to look for here is the Level 3 DC fast chargers, 100 to 200 plus miles per 30 minutes. This is going to be the easiest solution for you because you just pull up, you plug in about 30 minutes, for the most part is key, you're going to be able to get a full charge on your car. Now, there's a few caveats to all of this. The reliability of chargers is a big one. If you're driving a Tesla, it's going to be a little easier for you, but if you can't plug into the Tesla fast charger, a lot of these DC fast chargers don't work. And J.D. Power put out a study last year pointing to the fact that about 21% of drivers said they have driven up to a charging station where it doesn't work. So that's going to be probably the most frustrating part of your drive because you won't know exactly. There's also limited availability of chargers, so you might have to wait in line to get that full charge. And the key here, as you're planning out all this, be conservative in your estimation of the range. I would say leave about 10% there. You don't want to be stuck in a place with very little charge, with no chargers at all. So that's a key thing to consider here.
Yeah, that is definitely a key thing to consider. I mean, it seems like there's also kind of a business opportunity here if you got travelers. I mean, beyond just the sort of rest stops that we typically have in this country, which you're meant to stop at for what, 15 minutes or so, right? It seems like there would be a business opportunity for a little bit more of a robust stop for people to spend time at, spend money at, do more things at than just, grab a quick bite, for example.
Yeah, and we've seen some businesses like Starbucks take up that opportunity. They have talked about installing chargers in some of their stores or outside some of their stores. You've heard Elon Musk raise the idea of a drive-in because it takes a few hours if you're using a slower charger to charge up. So you're certainly right about that. I mean, that's something that we're likely to see in the years ahead as we think about how or where Americans are charging increasingly. But I will tell you, if you're not driving a Tesla, you really want to have to build in that extra time to make sure you get that full charge.
Interesting. Thanks, Akiko. Appreciate it. On the other side of the break, why our next guest says paying for weight loss drugs may save states money in the long run. We'll be right back. North Carolina's state health plan is denying some coverage of GLP-1 weight loss drugs, including Wegovy, Ozempic, and Mounjaro, as of April 1st. The state's saying the drugs are too expensive. Our next guest, though, says it's more cost-effective in the long term to continue that coverage. For more, we have University of Pennsylvania Vice Provost for Global Initiatives, Dr. Ezekiel Emanuel. He covered this in a recent op-ed. Dr. Emanuel, first of all, thank you so much for being here. So the state is saying that they are going to grandfather in the folks who were approved to have coverage of these drugs last year, but from April 1st, they are no longer going to cover them. Why do you think that this is not the most cost-effective move in this case?
So the justification for changing their policy, according to the executive director of the health plan, was it has to be we're guided by cost effectiveness, he said, and we have to do the greatest good for the greatest number. But in fact, if you look at the cost effectiveness analyses of these drugs for patients who have obesity, they're cost effective. They, in fact, meet his criteria, and they do a lot of good for patients who have obesity. Not only do they reduce weight, they also reduce their risk of cardiovascular disease by 20% in the first year. So they meet his standard of cost effectiveness. He did not actually do the calculations and examine whether they're cost effective or not. We also point out that the North Carolina health plan covers many drugs that are much less cost effective than the GLP-1 drugs like Ozempic and Wegovy for obese patients. They cover some cancer drugs, they cover some drugs for other diseases that are not as cost effective.
Wouldn't Dr. Emanuel, though, providing this coverage cost a lot of money? Where would that money be coming from? How would North Carolina pay for that?
So that's a separate issue. It's not a cost effectiveness issue, it's a budget issue. Things can be cost effective and still hit the budget hard, and I'm sympathetic to him. These are expensive. So there seem to me to be three options. One, you could try to reduce the cost of drugs and negotiate them down. You know, we've had Congress, which has been sort of reluctant to negotiate a lot of drugs. We have for 2026 the first bill ever to negotiate drug prices. I think, and I was a big advocate of that, I think that's a good thing. We could try to negotiate down these particular drugs because they're going to be widely used. The second approach is, look, don't just cut off a whole swath of people with one diagnosis. Like obesity, use the drugs for the people who get the most benefit or who need them the most. And the third approach that we argue is, look, you want to pay for these drugs? Tax the very problem that is causing obesity, ultra high processed foods and soda, sugar sweetened beverages. Tax them, use the money you get from the tax to pay for these obesity drugs. That accomplishes two things. You treat the people who have obesity today, and you prevent people from getting obesity by increasing the tax on these foods. That's another solution that they never even considered in North Carolina. And I think that is, you an ounce of prevention and the pound of cure.
What do you say, Dr. Emanuel? I'm interested to get your take, because when people propose, like you're doing, raising taxes on soda, candy, you'll often hear this criticism. You're unfairly kind of, hurting more low-income folks, right? I mean, you raise the price of a can of Coke by 10 cents, 50 cents. It doesn't matter. I'm still going to buy a can of Coke, but maybe lower-income folks couldn't. It's regressive, people argue. How do you sort of respond to that?
Well, obesity and the other diseases caused by those drinks and poor diets, type 2 diabetes and other diseases, osteoarthritis, the need for joint replacements early, the foreshortened lifespan, those are not good things either. And inducing people to change their diet to be more healthy is a good thing. And that's a very important effect. Bad health disproportionately affects poor people, I agree. And encouraging them to switch what they're eating to healthier items by taxing the unhealthy items, that's also a good thing for them. because it reduces their ill health, and I think would be better for them, both in the short term and in the long term.
I'm curious if you think healthcare plans are going to listen to you. And in other words, it's not just North Carolina, of course. There are a lot of both public and private health plans right now that are weighing whether to cover these drugs. And so do you think that this is going to continue to be problematic? And even though the health benefits of these drugs have been widely touted, we've talked about them a lot here from a profitability standpoint for these companies as well. Do you think that promise is not going to be fulfilled if the drugs aren't covered?
Well, let's raise 2 or 3 points here. First of all, the profitability is directly tied to the super high prices. And so I think part of the ethical thing to do is to bring those prices down. And I don't think we should keep the super high prices. And I'm hoping that with more development of these drugs, Viking Pharmaceuticals just yesterday announced that they had very good data results. Hopefully that'll keep up. We'll have a lot more drugs, and maybe that competition will drive the price down. The second thing I would say is that these are, we do have a big health problem, and we do have to recognize that there are things we can do in our society around the health problems. We created this problem overnight. We didn't create this problem overnight. It's taken us about 6 decades to get to this big obesity epidemic. I don't think this is the only way we should attack it, but I do think if we have effective treatments, we need to use them. When we have effective treatments for lung cancer or diabetes or cirrhosis, we use them. And I think we have to use an effective treatment for obesity.
Dr. Emanuel, when you refer to obesity here as I think you said epidemic, can you quantify that for us? How much of a crisis is it for the country?
It's a huge crisis. 70% roughly of the adult population is either overweight or obese, where obese is a BMI above 30. It's a huge problem for most adults.
Dr. Ezekiel Emanuel, thank you so much for spending time with us and elaborating on that op-ed. Appreciate it.
Thank you. Thank you for having me.
Take care. U.S. lawmakers reportedly reaching a deal to avoid a partial government shutdown and fund parts of the government through September 30th. Yahoo Finance senior columnist Rick Newman is here. Rick, this seems like another step here, but it still has to get approved, and it still would require this is just a delay? Am I reading that correctly?
It is quite tedious, isn't it? So Bloomberg is saying the Congress has not voted or anything like that. Bloomberg is saying that the leaders of, it sounds like this is coming from people in the Senate, that leaders of the House and Senate have agreed on how they're going to get out of this problem. So they haven't voted yet, but they have figured out they're going to have a vote. That's a big deal when the House can actually get to the point that it's going to vote on a bill. It's going to be a short-term funding bill. It's yet another short-term funding bill that will perhaps fund the government through the end of March, and that will provide time for them to work through all the details. I think this is only the first half. There are 2 parts here, because the way they've done it is they've set up 2 batches of spending bills. One of them expires on Friday, and the other one expires a week from Friday. It sounds like this just applies to the first batch, but that it could be extended to include the other batch. So it's not like we're going to stop talking about this. We're just going to do what we've been doing up to, all the way up till now every week, which is we're going to just push it forward. And anybody who thinks, now this will all just go smoothly, I don't think it's going to go smoothly. Because this gets right back to the problem that we have with this small group of super conservative Republicans in the House, which is they're going to revolt. There's a good chance they will revolt because they do not want this. They actually want a shutdown. And this is why Kevin McCarthy lost his job as Speaker last fall, because he actually agreed to let's vote on the bills and fund the government. And he lost enough support. So the new Speaker, Mike Johnson, could now find himself in that very position. But for everybody who couldn't care less about all the inside drama of Congress, it means we're probably not going to get a government shutdown this weekend. And we'll see if we can get through the rest of the year without a government shutdown. Wouldn't that be special?
We'll see. Rick, thank you so much. Appreciate it.
Bye, guys.
Let's take a look at what's trending after hours. We're watching shares of Snowflake sinking after hours as the cloud software company's product sales outlook for the next fiscal year missed estimates. Its fourth quarter results beating adjusted earnings per share and revenue. But perhaps more interesting or more significant to shareholders, longtime CEO Frank Slootman is going to be retiring from Snowflake. He'll be replaced by the company's senior vice president of AI, who was also a former Google ad chief, so that notable as well. Another name we're watching is C3 AI. The stock soaring after reporting fiscal third quarter results. Revenue that came in above analyst estimates at $78.4 million is up 16% from the same time last year. And subscription revenue also rose from a year ago, topping $70 million. On the bottom line, C3 AI reported a narrower than expected loss. And we've got shares of Okta as well, jumping on earnings by nearly 20%. The company's revenue beating estimates in its fourth quarter, boosted by large customer orders. The earnings beat comes just months after Okta disclosed a wide-scale security breach that exposed users' information. A welcome sign for investors, that is this earnings report, worried that customer orders could be affected by that hack.
And time now for What to Watch. Thursday, February 29th, starting out with the economy. Key piece of economic data releasing tomorrow morning. That's the monthly PCE report, Fed's favorite inflation gauge, giving us more insight into the central bank's decision to cut rates. Economists expecting the report to show a bigger increase in prices for January.
And moving over to the Fed, we'll get another round of commentary from 4 different Fed officials in the afternoon. Wall Street will be listening closely for clues about potential rate cuts after the PCE report. New York Fed President John Williams saying earlier today that the central bank still has, quote, a ways to go in its battle over inflation. Williams also reiterating that the Fed will likely cut rates later this year.
And finally, on the earnings front, AB InBev, Dell, Hewlett-Packard Enterprise, Bath & Body Works, and Best Buy all reporting tomorrow. HPE having a rocky start to 2024, down about 12% to start the year, and announcing earnings for the first quarter of 2024. It's going to be after the bell.
PCE, is that all? I mean, is there anything else to say about tomorrow? We've been talking about it for days now. It feels like weeks, although it's not weeks. But obviously, that's going to be a big tradable event for the market.
For sure. I mean, listen, we had that higher than expected CPI, and that certainly took the market for a turn there.
Yes.
NVIDIA kind of rode to the rescue, but it'll be interesting what happens tomorrow.
I mean, it's difficult to see anything in the numbers that will now change again the market's view that rate cuts aren't coming until later in the year.
I am very interested in earnings. HPE scheduled to report. This will be January quarter results tomorrow. Some analysts saying, going to watch that second half guidance especially carefully. I know some think there could be some risk there. There's going to be questions about what the integration of Juniper is going to look like. Remember, HPE announced that buying Juniper for that big $14 billion deal. The stock, as we mentioned, heading into this print, not great year to date, not great really over the past 12 months either. And by the way, our very own Brian Sozzi will be speaking with HPE CEO Antonio Neri about the results, and I'm sure a lot more. That will be on Friday, so tune in for that, Julie.
There's one more thing about tomorrow. It's February 29th.
Interesting.
Leap year day.
That is interesting.
I don't know if there are any market implications. If there are, we'll tell you about it. Well, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all your coverage leading up to and after the closing bell. Happy leap year, everybody.
Is that an expression?
No.